Hi, I'm Bill Blain, strategist for Shard Capital. Let's talk about the growing disconnect between where the global economy is heading towards the deepest recession we've seen in over 100 years and where stock and bond markets are heading towards record levels. It looks like in the next few days even we might see stock markets pass the record highs that we had before the March meltdown in stock prices. Why is it that we have seen such a recovery in the market despite the global outlook looking so bad? Well, it all boils down to a discussion about quantitative easing and zero interest rates. QE infinity, which offers to buy back bonds, including sovereign debt and corporate debt, has thrown a support under the bond markets. As a result, we've seen enormous volume of bonds issued by corporates who are keen to build up cash reserves ahead of the coronavirus recession. We've also seen governments feeling confident about announcing the enormous support packages that have kept the global economy going through this crisis. And that has been a very positive thing, the speed at which governments and central banks have acted to address the lockdown and the economic consequences it created. Furloughing staff, paying salaries and making cash available to corporates has avoided the very worst scenarios of complete corporate meltdown. But unfortunately, it also traps us in a very, very different environment, and it's not necessarily a bad one. And to understand that, we need to go back to the genesis of quantitative easing following the 2008 global financial crisis. At that point, central banks came up with the idea that buying back bonds from the market would put cash into the market, which would then be invested in the real economy. Except there was a flaw. It didn't work that way. What happened was banks were very happy to sell their bonds to central banks, but the money they got was not re-lent out and circulated into the economy. No, that money was invested in buying more bonds, which central banks then bought. Interest rates went lower and lower, and investors realized that to get any return, they would have to start buying other assets. So they bought corporate bonds, and the spreads and returns on corporate bonds got tighter and tighter and tighter. In the search for yield, they had to go and buy equity because they were looking for returns there. As a result, more and more equities went higher, and corporates were able to borrow more money to buy their own stock back, pushing equities even higher. And many of the equities that went so high were all these new techs that weren't paying any dividends. So the returns were purely based on the price of the stock. This is the situation we found ourselves in at the start of 2020. Enormously inflated stock markets and bond markets at artificially low rates. And that system has been exacerbated by the response to the crisis. It's even worse now. All the inflation that we once feared would have been generated by quantitative easing has occurred, but it hasn't occurred in the real world. It's occurred in financial assets. Now the big question is, how do we wean ourselves off this? Because clearly it cannot continue. We need to see a properly efficient and functioning market for the global economy to work at its best. But unfortunately, the invisible hand of markets has been pushed completely out the way by quantitative easing. How do we undo the consequences and implications? Well, it's going to require a massive and radical rethink about what governments do. And it's going to require long-term intervention in the markets. And that probably means governments stepping in and buying equity of companies that are struggling as a result of the coronavirus and taking equity stakes in them and being involved in them, which raises the risk of bureaucratic control by government. But it also means pushing up interest rates to force that money that is being injected in through quantitative easing to actually go into the real economy. This is a really dangerous time for markets, because at the moment the markets are betting that QE infinity means forever. But unfortunately it can't. Sometime it has to come to an end. And managing that process is when markets are going to get really dangerous. At the same time, we cannot continue with this disconnect between soaring markets and a collapsing global economy. We've seen how that plays out in the States this weekend with riots in over 30 cities. We're only just at the beginning of what looks to be a very long and hot summer. And if the predictions are right that over 40% of furloughed workers are never going to go back to their jobs, then the discontent in cities across the Western world is only going to get worse. And if we see the global economy continue to nosedive the way it threatens to do, then the consequences are going to multiply. We are going to see multiple corporate defaults as they can't pay back their debt. But even more critically, we're likely to see increasing numbers of sovereign debt crises across the world. We're going to see countries that have borrowed in other countries, in other currencies, which is especially true in the developing markets and resource-rich nations where they borrowed dollars, unable to pay back that cash. That's going to create all kinds of shocks in the global supply chain, but it's also going to create conflict as China and the Western economies compete to try and get access to these resources. You're going to see more of the kind of resource allocation conflict that threatened over the last 10 years. All in all, the picture is bleak unless we can somehow control quantitative easing. And that's where we need to talk about modern monetary theory. Let's just think about it for a second. It is a kind of magic, but if a country is borrowing money in its own currency, that then is a liability for the Treasury that issues the debt. If all that debt is bought back by the central bank, that's an asset of the central bank. Do you see where this is going? If the two of them meet in the middle because they're both part of government, wham! All that debt just magically cancels. Maybe that's what we should be thinking about as a global cure to how unbalanced the global economy has become.